Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events, both technical and fundamental driving markets at the moment. Whilst I just let you have a look at the disclaimer, I'll just run through what we hope to cover in the next 45 minutes or so. We'll first kick off with where markets are currently. We'll look at one of the themes potentially of this year, volatility, and then we'll look at equity market stocks with the earnings season very close to us, and we'll look at some of the technicals around some of the US indices and also some of the European indices, so the DAX and the FTSE looking quite interesting. We'll then review non-farm payrolls, the US employment report from last Friday, and its impact on the Fed outlook and also the dollar. And then we'll cover this week's main event, great big event on Thursday. The US CPI figures, of course. We'll look at the numbers expected and also then look at gold as it hits 8-month highs this morning. So a lot going on actually to start off the new year. So let's get to it. Yes, so markets currently, stocks really, risk markets beginning the week on the front foot, really. Gains in Asia and US futures pointing higher. The reopening continues apace in China, really, as air travel resumes without the limitations that have hampered movement over the last 3 years. We highlighted actually in our daily communication, our daily commentary actually, that the leading MSCI Asian indices have entered a bull market, so up 20% since the October lows. And the markets there really betting on a shallow recession or generally in some parts of the world as well, on top of course, a successful reopening of the Chinese economy. We also had Friday's payroll figures, of course, in the US. They provided kind of just the right blend of payroll gains without excessively strong wage growth. And we also had actually the week, so a sub 50 December ISM services survey, and that, or these, both those data points really prompted a surge in stock markets and some quite strong dollar selling, really on hopes that the Fed may begin to think about pausing its hiking process earlier than expected, and then potentially we're getting more easing, so rate cuts priced further out. But of course, we do have that US CPI data on the calendar. We also have an appearance by Jerome Powell, the Fed chair, on Tuesday. So certainly markets will be keeping an eye on those couple of risk events. But otherwise, quiet sort of calendar start to the week, if you like, data-wise. And as I've mentioned, we do get the Q4 earnings season beginning in the US on Friday. Just before we look at that, I just wanted to highlight one theme, market volatility really, which potentially is always bubbling under the surface, if you like, and can take off. Obviously, last year, 2022, was about the inflation shock and then the interest rate shock. Essentially, that revolved around changing expectations around the likely size and speed of monetary policy tightening in the face of obviously this high and persistent inflation that we saw. And central banks really struggled to give consistent forward guidance. Confusion in markets then drove sharp swings in bond yields, which we try to concentrate on, not look too deeply on, but try to really get a handle on those for you and just sort of highlight those swings in the 10-year Treasury yield and also the 2-year Treasury yield, which maps sort of Fed funds futures, so US interest rates. And then those sharp swings higher, and then sort of the pullback also, they destabilized equity markets. Really, as we saw, one of the most aggressive Fed rate hiking cycles ever. And you can see on this chart, the current cycle is this dark blue line. So you can see really the sheer sort of pace of that, of this cycle, this current cycle, how steep that is compared to previous other cycles of tightening. And yes, the most aggressive that we've seen, or one of them ever. That's tightening cycles. In amongst that, then we also have another chart actually, which just shows you again where we've come from, obviously, and where we are sort of compared to previous years, previous changes in Fed policy. And you can see, we have to go back many decades to get to sort of the current sort of size of the rate tightening, policy tightening that we're getting, or have been getting since March of last year, really. For 2023, then this year, volatility potentially could rise again, especially in the first half of the year, as really the global economy tries to adjust to this sort of steadier, newer state of activity and higher borrowing costs. And it's this uncertain outlook, which means central banks may actually reduce their forward guidance, even though it was slightly confused. They'll reduce it so as to give themselves further flexibility in their decision making. And more data-dependent policymakers really means financial markets will be sort of less spoon-fed on the future direction of monetary policy, which then increases the scope for surprises. So we kind of think this is something really to bear in mind going forward for the next few months at least. Certainly, though, as well, we have to bear in mind that major central banks, the Fed, are closer to the end than the beginning of their tightening cycles. You can see on this chart, obviously, where we've come from, that steep pace of aggressive pace of rate hikes. And then you can see where we are currently, potentially, we've pulled back from that sort of 5% marker, but we've sort of markets have really priced in around 5% for the peak of Fed funds, and then whether we then roll over towards the end of this year, potentially, or the second half at least. So just sort of trying to give you a picture of sort of last year, really, a quick recap on that Fed tightening cycle, and then this Fed funds rate and how high that goes, and then potentially rolls over. And then just sort of wrapping this idea up, then increases in long-term government bond yields, treasury yields really should be relatively modest going forward, you kind of think, because we've seen such a rapid pace of hikes. And even if the length of time that rates need to stay high is obviously still up for debate. But certainly the hope is that for this year, going forward, firstly, that or initially, more stable fixed income markets, so treasury markets, potentially means lower stock market volatility. We shall see, of course. Concerning then equities, just pull up the chart firstly of the S&P weekly, actually. So US stocks, they ended the first week of this year higher, with the blue chip S&P actually closing up 2.3% on Friday, bringing gains on the holiday shortened week to 1.4%. The tech heavy NASDAQ, that gains 0.9% across 4 sessions, after adding 2.8% on Friday after the non-farm payroll report, of course, and that very weak December ISM services data. But the non-farm payroll sort of regarded, people, economists, analysts, calling it a Goldilocks type report. So not too hot, but not too cold, really, if you like. And that sort of eased concerns with that data, that weak data, about an overly aggressive Fed. Interestingly, for the new year, most on Wall Street are suggesting certainly recession in Europe and then also the US, although equity internals kind of point to lower probabilities, especially in the US, below sort of 50% on some metrics of that outcome. But falling bond yields should help valuations, and the overall market could potentially then trough in the second quarter of this year as the Fed pauses its rate hike cycle. It's really a balancing act then, isn't it, for central banks and the Fed, with monetary policy intended to slow the economy as a way to temper inflation without, of course, pushing it into recession. But a slowing economy certainly will have an impact on corporate earnings. And there are a number of questions about how far earnings may slow, which could create headwinds, of course, for stock markets. As I said, the Q4 earnings season in the US, that starts this week with major US banking earnings, most notably from Bank of America, JP Morgan, and Citigroup on Friday. Analysts, I think stock analysts at least remain muted on US bank earnings, banks, with earnings expected to show another quarter of negative growth compared to a year ago. And then for the overall sort of season, Q4 earnings season, 7 out of the 11 S&P 500 sectors are expected to see earnings contract, making overall S&P 500 earnings growth unlikely. And it's only energy, industrials, real estate, and utilities that are expected to show some growth. There will likely be more industries experiencing margin compression than expanding margins, and that will be this major headwind for earnings growth. Also, current analyst estimates have not been materially revised down. So that means certainly this upcoming season and potentially beyond that could be paved with more disappointments. So just looking technically at the S&P, the weekly here, you can see we had sort of 4 weeks of losses. That's not been seen since May, but sort of that was into year end. So volumes were light, ranges relatively small there, apart from those first couple of weeks. Support then, we've got this fib level, 38.15, the 38.2 fib level of the move from the 2020 low. So long-term fib level on this weekly chart, you can see. Initial support, if you like, at 38.15, you can see held for the last few weeks at least on the weekly. And then above here, of course, you've got this long-term falling trend line. We've said quite a few times over the last few weeks, it's tapped a number of points, price points really. So that sort of reinforces in a way that trend line as resistance, capping the upside there. And then also you've got the 50-week moving average at just above 4,000, 4,057, you can see. So if we just drop to the daily, again, you can see that resistance capping the upside there. If I just pull it out, 4 or 5 points or so, where prices have turned back from that trend line. And then near term, you've got sort of, you've got the 200-day moving average actually at just around 4,000, just below there. So again, reinforcing that sort of level, key psychological level as well as technical level then. And then near-term resistance, probably the 50-day moving average at 39.04. That light blue line, is the 50-day. Sort of lighter grey line is the 100-day moving average at 38.86. So we're trading around there. If we do push up, then we get back in potentially to this sort of range trading from November and December with very strong resistance, as we've said, around 4,000. That's for the S&P. Interesting, obviously, this sideways trading that we've had for a while, and then obviously that upside break after the non-farm payroll and that week RSM services data. So support below that 38.15 fib level would be that recent low, 22nd of December low, 37.64. That's the S&P. Just looking at other indices, the NASDAQ, we'll just look at the weekly, again, long-term fib levels. Trading sort of between the midway point at where 11.768. This is a NASDAQ 100. So we're below that now. We're below the 200-week moving average, probably more widely looked at, 11,500 really, that 200-week moving average. So we're below there, which will probably offer some resistance. And then you've also got the mid-June low we've cited quite a few times at 11,037, which we're trading just above here. So potentially, yeah, those are the levels to look at near term, as long with then that falling trend line that you can see sort of tallies with the halfway point around there for the NASDAQ. The Dow, again, well, obviously a much bigger rebound from those October lows, sort of oscillating just below those October highs then, but sort of support being found at the 50-week moving average. That's the light blue line there, 32,729. Also that halfway point then sort of looks more, the halfway point then that is of the 2022 move. That halfway point coming in around 32,850 or so. So that also offers support. And then the upside potentially capped by the next fib level, 33,806. And then if we just look at the dailies, you can see sort of that 34,281 level from the summer high, potentially big area zone, if you like, of resistance along with these highs from November and December, that December high at 34,712. So interesting, again, breakout from sort of that consolidation period, and then potentially bouncing off that fib level, the midway point, potentially then moving up into the sort of 34,000 and above, if we can sustain this upside. A couple of other indices I said we should look at, quite interesting. The DAX, so this is the German equity index. Just on the weekly, we had 8 straight weeks of gains. You can see from the October lows, that's not been seen since, I think, May 2018. In fact, this rally from those October lows up to this sort of point where we are now, 24% rally from those October lows. And now really we're on, you can see, just trading above a fib level, 61.8 fib level, 14,581. This is the DAX. We've also got the 100-week moving average, 14,585, so reinforcing really that level, which had acted as resistance, you can see, in November, December, and now potentially we're breaking above it. Really massive move. Last week, what was it? Let's have a look, percentage-wise. Where are we? Up nearly 6% last week, the DAX. And then potentially, yes, if we can sustain this and that acts as then strong support as opposed to flips from resistance to support, then potentially we move higher up to sort of 15,000 or so in the DAX. So interesting point here as well. Just highlight as well a key area for the UK FTSE actually. We're now at fresh, or just, well, we made earlier today, let's just have a look at the daily. Yeah, earlier today we made fresh 2-year highs in the FTSE, above 7689, that January 2020 top that was 7689. We're now at 7695. You can see, so it's just above that level. If we just go to the weekly, more interesting, because you can see we sort of topped out a couple of times earlier at the start of last year, February, and sort of April time, couldn't sustain a break above this sort of level. So really interesting to see if we can move above that, and then it acts as support, and potentially then we're looking at the highs, the all-time highs actually. Well, firstly, the January 2018 high at 7792, and then the May 18 top, which is the all-time high. Actually, it's, as I said, at 7903, just above 7900 for the FTSE, but really dependent on whether we can break that resistance around 76.89 on the week really is probably important, a close above there. So those are the levels of interest on the major stock markets. If we just go back to now reviewing some of the data from last week, primarily the non-farm payroll report, and then also a couple of other data points of interest, as well as the some of the Fed speakers, Fed officials. But firstly, non-farm payrolls, just a sort of graphic with a load of numbers, but you can see the headline, unemployment rates, obviously wage growth, and then some sort of 3-month averages of the headline print. But just grabbing the main points really from this graphic, payrolls broadly in line with expectations, unemployment rates indicate strength still, but wages indicate softening inflationary pressures. 223 jobs added in December, a little above the 200K consensus. Net 28K downward revisions to the past 2 months. So really, if you add that all up, we're broadly in line with what was anticipated. It was actually the 5th straight month of slower jobs growth. I put on here the 8th straight beat, but yeah, interestingly, the 5th straight month of slower jobs growth. Unemployment 3.5% versus 3.7% consensus. That's down from the downwardly revised 3.6% in November, initially reported 3.7%. So a very strong number in the jobless rate. But we also kind of have to not forget that the low unemployment rate masks the fact that more than a third of the working age population are not engaged at all. So that's that participation rate, which is just at 62.3% or so. A key focus going into the report we highlighted was the annual rate of wage inflation, so average hourly earnings. That's now just in inverted commas at 4.6%, whereas the market had been looking for 5%. Last month's 0.6% month on month, that also was revised down to 0.4%, while the December month on month figure that came in at 0.3% versus an expected 0.4%. So we have that weaker trend materializing, really, it seems, and the market reacted to that. One thing to note here for us, wage growth, you have to remember, didn't really cause the inflation or inflation in the US that we're seeing now. So potentially it's not that key reason as to why it ultimately falls. But certainly the Fed is concerned about wages feeding into core services inflation, as Fed Chair Powell has repeatedly actually told us. So to get that inflation, services inflation, and we'll go into that briefly in a bit more detail later when we look at a preview of the CPI. But for services inflation, to keep that in check, most economists reckon the Fed needs to drive wage inflation down to a range of 3 to 4%. So we're at 4.6% now. Most think, yeah, we need to be in that range of 3 to 4%. And that will require a sort of persistent string of payroll gains of less than 100,000, most economists reckon, per month. And then we'd get a rise in the jobless rate to at least sort of 4.5% or so. So just sort of figures to bear in mind going forward, really. Also, labour data is a lagging indicator, so it's the last thing to turn in an economic cycle. Also, then we should sort of focus on data, really, economic and the economic outlook, and that has been deteriorating as the Fed obviously continues to hike rates in its battle with inflation. Last week, the ISM report for manufacturing orders that contracted for a fourth consecutive month. We also had that unexpectedly weak services data. And then also the Conference Board reported that CEO confidence is at its weakest since 2008, actually. So the GFC in 2008, and even weaker than at the worst point in the pandemic. So for jobs, really, that sort of kind of points to potentially a more defensive stance by businesses, a greater focus on costs, of course, and that will include labor costs. And we can't ignore a lot of these job loss announcements which are coming out of the US. Primarily, sort of the headlines being grabbed by the tech sector. Amazon, of course, 80,000 jobs, plus other tech companies. But potentially we can expect that to evolve into the wider business, wider businesses really in other sectors over the next year or so. Just going back, actually, stepping back to that one data point, that ISM 49.6 from 56.5. So not only below consensus, but also below the lowest estimate, actually, from analysts. And then also below that 50 boom and bust figure. And that's for the first time, actually, since May 2020. And certainly a lot of economists see readings under 50 as one of the most reliable indicators of the economy headed into a recession. So market reaction after those two data points, obviously the big one, the non-farm payroll, but then also that ISM, the week data as well on Friday. We saw treasuries, US treasuries, which we like to look at, those yields, they plummeted on the 2-year by more than 20 basis points. And then interestingly, just talking about the yield curve, but don't want to get into too much detail then, you had very short dated 3-month bills. Those yields exceeded the 10-year treasury by a full percentage point, and that's the first time that's happened in decades. And again, that gap is seen by many as a reliable signal that a recession is in store. If we just look at that, actually, quite like to look at that from a chart perspective, just to give you an idea of this. So the 2-year yield you can see there, that's on the weekly. But you can see that big drop, and 20 basis points might not mean much, but you can see that big red candle really that we haven't sort of got since, say, back in November. Was that 20 basis points or so? Yes, it was, from the high to low. But again, similar size move, actually, high to low, that candle. And then we sort of have to go back to sort of start of November for a similar size move. So decent moves in yields, yields falling, of course. And then you can see the 10-year as well, that Friday's move, big move there, and closing in, sort of moving down to, where were we on the low? 3.55%. Remember, we're at 4.33% back in the end of October. So sort of this move lower, interesting. Obviously, then a sort of a rebound before then pulling lower. This is the 10-year US Treasury yield, and I've just highlighted really that difference between very short dated yields and then the 10-year being a full percentage point, actually, as I said, for the first time in decades. So for money markets, which is also important for referencing Fed meeting dates, that's really showed investors now expect the policy rate to peak just over 4.9% in this cycle in June. That's down from, I think, near 5.1% just before the non-farm payroll release. And traders then remain split about the size of the February Fed funds or the FOMC move. 33 basis points, I think, priced in, suggests really that 25 basis points is now considered more likely than a 50 basis point, a half percentage point move. Longer dated contracts, they still anticipate rate cuts by year end now, with rates to fall below 4.5% potentially at year end. And that was previously around 4.7% before the non-farm payroll release. For the dollar, just generally then, the sell-off after the non-farm payroll, obviously you can see here, we're back to near the lows again. Just sort of bigger picture for the dollar then. If I just go to the weekly, just to obviously highlight what we've been talking about over the last quite a few months, of course, last year or so. 18-month bull trend in the greenback, most traded, most crowded trade last year was obviously long dollars, and that really has changed and flipped massively, really. And we're now modestly actually bearish for a lot of speculators positioning in the dollar. The final quarter, as you can see, of last year, we saw a big breakdown in that uptrend, and that trend had been worth 5% per quarter over the first 9 months of last year. That rally obviously driven by the Fed wanting to take policy into restricted territory. Going forward then, conditions for a prolonged downtrend in the dollar. So you can see, obviously, we pulled back. Dollar was still up 9% or so on the year. But this pullback then asks the question about what happens to sort of break this medium-term, near-term support, really, and whether we get more prolonged downtrend in the dollar. Certainly, we need to see the Fed take a back seat, and that means really a decisive shift in their rhetoric. That would also mean the short end of the US yield curve, so those 2-year yields would need to soften even more and quite appreciably. And then a decline in the dollar, well, that reflects and contributes to positive outcomes in the global economy, as typically the greenback falls during periods of rising global growth and rising growth expectations. But that means, of course, an environment which is attractive enough to draw funds out of the dollar. And certainly at the moment, with the European economy struggling slightly, although obviously doing better than many thought, and then also a slowdown in China as well, although the reopening obviously is peaked hopes, if you like, but that might be a bumpy road, certainly towards full recovery. Then interesting, yes, whether the other parts of the global economy really are attractive enough to pull, as I said, those funds out of the dollar, for us to see a more protracted sell-off. And then we also need to consider liquidity, because as central banks reduce their balance sheets in what we term as quantitative tightening, so QT, that means lower excess reserves, tighten liquidity, really, which then raises FX volatility as well. So something to consider. Those are the sort of potential points for a prolonged or more prolonged downtrend. Flip side, certainly, near term, there are seasonal trends which typically see the dollar rally in January. It's the strongest month of the year over the past 25 years or so, according to some analysts. And the dollar also may get some support from still its relative economic resilience, for sure. And as we mentioned, that sort of softening or softened global growth, really, then you get that sort of contrast with the US still being relatively resilient. And then also we can't forget, obviously, mixed risk appetites, geopolitics, Ukraine wars, obviously rumbling on. If we do see that ratchet up, then we would potentially get safe haven buying in the dollar. Technically, we can see the weekly chart here, of course. You've got, we've consistently highlighted the 102.99 area for the DXY, support level. That's the pandemic high. If we just scroll back there, you can see that quite nicely. And then we've got some fib levels in here. So The halfway point of the dollar move of last year is 104.74. That tallies with the 50-week moving average really at 104.66. So upside resistance there. And then support, as I said, sort of around 103, and then below that, sort of 102.32. If we go into the daily, you can see we did highlight this, I think, on our weekly commentary, just a death cross. So 50-day moving average, shorter day, simple moving average converging, and then crossing below the 200-day moving average. And it kind of reflects price weakness, of course. Kind of ominous name, but really it's potentially not that dire. I think history kind of suggests we could possibly just sort of trade around here, but obviously with that non-farm payroll figure, then we've moved lower, and potentially the low of the recent trading range is 103.39. So that's to look out for. And then, as we said, that pandemic high at 102.99. That's on the DXY. Okay. Just moving on then for the main risk events well, this week, the CPI, US CPI figures released on Thursday. Firstly, bigger picture, like to think that the current inflation is a guide, or current inflation, is a guide of how much further the Fed has to hike, with recent data obviously pointing to an imminent end to the hiking cycle. Whereas, say, the jobs data is a guide of how long it would take before it decides to cut rates. Hope that sort of makes sense to you. So if last year's hot and sticky figures fall faster than most investors forecast, even if they don't stabilize at or below pre-pandemic levels, this will, of course, allow the Fed to stop their policy tightening earlier. And a less hawkish Fed will see markets price lower policy rates, of course, and then this potentially a further weakening in the US dollar. Certainly, and we can see on this chart, we've actually got a different form of inflation, but PCE inflation, but still similar picture, of course. That's still high, and you've got Fed funds rate obviously trying to catch up, and you can see that most aggressive cycle, as we've highlighted before, potentially catching up towards PCE inflation and that peak of rates back in sort of 08. Potentially also then central banks sort of, again, bigger picture, as I think we highlighted it actually in one of our written pieces, but they can always bring inflation down. It's simply a matter of how much growth they're willing to sacrifice, central banks, by lifting rates. And now it's this balancing act, as we said earlier. It's about threading a needle to engineer a soft landing, really, by slowing growth and economic activity, but just by not too much. So for CPI then, you can see the chart here for the figures. Really, headline CPI is to print, expected to print a 0.1% month on month in December. That matches the prior rate, while the annual rate is expected to fall to 6.7% year on year from 7.1% previously. That would actually be the first time it's fallen below 7% in 13 months. And you can see that falling trend here on this chart. Goods prices continue, and this is where we sort of mentioned before about this difference between goods prices and services prices. If I've just got the chart here that you can see, don't want to get too technical again, but the blue line, the black line really is goods prices, and then this light blue line is services prices. You can see goods have fallen as supply chains have got better, improved, while services inflation is sort of rising, but is slowing now. So interesting, really, what we get from the figures on Thursday. As I've said, services inflation will continue to be supported by shelter prices. but some economists see those peaking in 1 to 2 quarters time and then falling into year end. A decline in gasoline prices then will offset the upside in food inflation that we're still seeing. For core CPI, that's likely to have risen. Where are we? 0.3% month on month, picking up a touch from the prior 0.2%, though the annual rate of core inflation is seen easing to 5.9% year on year from 6%. And that's that darker line there. Certainly a report in line with expectations would be reassuring for the Fed, because as we said, it considers slowing and eventually pausing the hiking cycle in a few months' time. Downside surprises in CPI, we should mention, in previous releases, obviously were a catalyst over the last year or so for the dollar reversing lower, and they've been quite a big event for volatility. So certainly reason why we're spending some time on it. We also get further views on inflationary pressures on Friday, actually, from the University of Michigan's quite closely watched consumer sentiment survey. Although consumer sentiment has barely recovered from all-time lows, and there's only been a slight pickup in the index is anticipated actually in January. The survey's gauges of consumer inflation expectations have been slightly more encouraging. And both 1 year and 5 year inflation expectations confirm the recent peak highlighted by the CPI, as we've shown, and PCE as well. So if there is a further decline in January, this again could lift sentiment at the end of the trading week. That's on Friday. We also, other risk events this week briefly, watch out for Powell speaking on Tuesday. He's at a symposium organized by the Swedish central bank, the Riksbank, and there's also other speakers actually, Bank of England Governor Bailey, I think Kuroda as well, the Bank of Japan's governor, is also potentially going to speak. Topics around central bank independence, I think, but Powell certainly, Fed Chair Powell, he hasn't. We haven't had any public remarks actually from him since the December FOMC meeting. So potentially, it depends if he carries on that more hawkish rhetoric, really, that we saw last week from some of his colleagues, actually. They argued for keeping rates above 5% well into 2024, actually. So against these expectations for that markets are having, really, for cuts towards the end of this year. And Fed officials, they also advocated against celebrating prematurely, actually, against the slowdown in inflation. And that kind of matched the Fed minutes that were released on Wednesday of last week. So interesting. We've highlighted it in our daily commentary, actually, just these differences between what the market thinks and then also what the Fed officials have been saying recently. Right, finally, just a very brief look at gold. Always interesting to look at the precious metal. Let me just pull up a chart. First of all, we'll pull up a weekly chart so you can see this very strong move that we've seen today. I think we've hit 8 month highs, really. Yes, 8 month highs, just come off those highs, actually 1881, the high from today, currently trading at 1874. Really positive momentum, as you can see, from last month, really carried through, really from October lows especially, but from last month as well, where we've kicked on last week. You can see that breakout, really, and that strong move higher last week. The precious metal, I'm just seeing, was up 2.3% on the 4 days of trading that we saw. That was its best weekly performance since the end of November. Obviously, we got a big boost from Friday. Let's just drop down to the daily. You can see that move on Friday due to obviously the jobs report and then that weak ISM services data that really triggered that plunge in yields that we've shown you, and also the selling in the dollar. Remember that higher interest rates, they dim bullion's appeal as an inflation hedge, and they raise the opportunity cost, of course, of holding gold, which is a non-yielding asset. So going forward, certainly a softening of the Fed's hawkish stance, an eventual peak in central bank rates, along with still historically elevated inflation, let's not forget, and then also potentially a weaker dollar. That could all help the yellow metal this year. Also, we've seen central bank buying. That's been a feature over the longer term with strategic diversification. So central banks, in particular, they have been buyers for many years now amid a broader trend of diversifying dollar-denominated reserves. There is a limited pool of assets really that make up reserve portfolios, and gold has historically been held by central banks, as well as sovereign wealth funds. So something to bear in mind there, longer term sort of driver, diversification driver it is. But certainly as well, in the near term, central banks remain active. The PBOC, so the People's Bank of China, they said they bought another 30 tons of gold in December of last year. That follows on from 32 tons in November. So boosting the company's stash of gold over 2,000 tons. Also, total ETF holdings, always a driver for in the medium term, certainly for gold. That reached a 1-month high recently, while speculators, they started the new month, the new year really, new month, new year, by boosting their net futures longs to a 7-month high. Quite a few factors there, sort of being quite bullish really for gold. We have to see sort of the peak dollar in, peak yields in, driven then by recession risks, if you like. And on the chart again, if we go back to the weekly, we can see that upward bias through most of last month. We traded around the we've got the 50-week moving average and the 100-week moving average. We traded around there. If you look on the daily, we highlighted actually the 200-day moving average around 1780 or so that we traded around through most of December, up above and below that. But that certainly now acts as support along with a fib level that you can see there around 1789. We pushed above there, broke up to the upside, and then pushed up through to the halfway point actually of the 2022 correction. That's at 1842. So really the next major hurdle, would be the next fib level. Let me just pull this up so you can see this is better, which is 61.8 fib level, which is at 1896. So that's the sort of next major hurdle for gold bugs. A break above there, confirming that change in direction that we've seen, which has been underway really since sort of end of October, start of November. So interesting times for gold, certainly. Okay, we should wrap it up there. Lots to talk about. Lots to watch in the week ahead, certainly. Please do follow us on social media. And all the best in this second week, this first full week of trading of 2023.